Hey friends, I'm back. I bought a new position in my portfolio. I just bought it. It's an ETF. I want to share that with you in the video today. Before I do that, I want to share the background. As you can see on the screen, we are in right now a time where there is a lot of news. Every day there's news that we are consuming as investors, and I try to ignore the news at a meta level. I just like to stay the course. I like to focus on what I'm great at, which is dividend stock investing. But it's important I remind myself to always fine-tune my strategy as is needed for our changing times. I believe right now we are in times here in the US of disruption. There's times right now where the system, it's changing, it's evolving, it's a bit chaotic as we go through these changes, and I want to position myself accordingly. So as you can see on the screen in front of you right now, overall, what if the US market, the US stock market that is, the US GDP, just the US market in general, what if there's slower growth ahead? There have been times where the US market, it's traded sideways for very long periods of time. There's been bear markets, there's been sideways markets. One of the most recent examples is if you just look at the major indices, especially the S&P 500 from 2000 to 2013, about 13 years, it traded sideways during that time. That was right after that huge dot-com bubble. Overall, I could see something like that happening in the US over the coming years as we digest all of the growth that has happened. Look, I love being a dividend investor, especially if we're headed into a sideways or even a bear market of sorts. I love being a dividend investor because I don't rely on capital appreciation to pay my bills. I rely on dividends, cash flow from world-class companies that have proven time and time again to pay their dividends during good times and bad. But of course, if our GDP slows down a bit, if we have a bit of a recession, the dividend growth, it will be slower going forward. And that's something I'm preparing for. That's one of the reasons I made this decision to actually diversify with the position I'm going to share today. By the way, this is old school PPCE and everyone, super old school. I'm in the garage today. It's hot. It's a warm day here in Idaho, just like those warm days I used to have back in my garage in the Bay Area. So put in the comments below if you remember those videos from the olden days, but here I am sweating it out in the garage. But I must continue. As you can see on the screen in front of you right now, it's almost easier for me to invest in a market that's trading sideways or even down because the capital I invest, it just goes further. I get more shares for the money deployed. I get more dividends for the money deployed. That being said, sideways markets are also indicative of companies digesting their growth. Read, companies, they're just not growing as fast. And as a kind of cornerstone of the dividend growth strategy is growth. It's the word growth. And so if there's going to be possibly less growth, that's what I'm seeing right now in the US. If that happens, the dividends may grow a little bit slower. And so this is kind of the crux of the issue. I actually posed this question over on Blossom. By the way, I'm going to share in the pinned comment below my link. It's an affiliate link. In terms of full disclosure, I'm compensated if you sign up from that link, but it's free to sign up. Blossom. This is the social media platform for investors. It's a great community. I'm on there almost every day. I posed the question to the team there on Blossom, to the community, and I said, hey, what are your favorite ETFs that are internationally focused? That's the topic of the video today, international investing, because I want to hedge my bets. I want to invest outside of the US. I have a stock portfolio that's very US centric. I have a few positions that are international positions, but more or less, I am US centric. And the reason I've been US centric is because I've always relied on my US companies that are multinational companies that do business outside of the US. But I kind of posed the question to Blossom, share with me your favorite ETFs that are international, that have broad international diversification, that are based internationally, that have some exposure to emerging markets, that have dividend growth, that have a high starting yield, 3% or higher, and I got some of the best suggestions. But anyways, I love Blossom. Check it out in the pinned comment below. Great community. If you sign up from my affiliate link, in terms of full disclosure, I'm compensated, but it is free to sign up. It's an amazing platform. But anyway, I posed that question. So I'm really thinking internationally these days. And as you can see on the screen in the next slide here, let's keep going. So basically one scenario, I want to hedge. I shared this on my Patreon recently in a blog post and a trade update. I'll link to that in the pinned comment below as well. I want to hedge. I want to hedge against so many things because there's so many uncertainties. I want my cash flow to be so strong in any kind of market. But one scenario right now that I want to hedge against, that I am hedging against, is a multipolar world versus US dominance. Over the past, over the history, recent history that is, as long as I've been an investor, the US really has been that dominant global leader with a huge kind of network globally. And the US companies have benefited substantially. We've had a lot of trade imbalances over the years, and because of those trade imbalances with the US consumption, a lot of US dollars have been spreading around the world, going all over, and those dollars, a lot of them have come back. They came back in our capital account in the US because they've been invested in US treasuries. They've been invested in US dollars. They've been invested in US equities, US company debt as well. And it has created a system of just this US dominance, and it's been a virtuous cycle of sorts for US-centric companies and US multinational companies. But as I look forward, things are changing a bit in our world right now. And again, this is really important. This is not meant to be a political commentary. I'm not taking sides. I'm not saying this is bad. I'm not saying this is good. I'm saying this is what seems to be unfolding before our eyes, and I want to hedge if this actually is the way our world is going. But I see us moving more towards a multipolar world, meaning there are multiple countries throughout the world that are dominant in their own ways versus just this huge US dominance. And we're seeing that right now with the tariffs, for example. The purpose of the tariffs is to help rebuild the middle class in the United States. And if we bring manufacturing back, it's going to fix some of the trade imbalance. But as the trade imbalance is fixed, there may be, from our capital account surplus, we may lose some of that capital account surplus. Long story short, there are certain US multinational companies, many of them that I own, that may be slower going forward that I'm trying to hedge against. But as you can see on the screen, let's keep going. So basically, hey, what if this scenario pans out? Maybe it doesn't, and that's fine too. But if it does, we could have faster growth outside of the US versus inside the US over the coming decade. And therefore, there could be faster dividend growth rate opportunities outside of the US. The US multinational businesses, could they face challenges with their international operations? I've gotten some field reports just from different friends over on Blossom and other social media platforms like X that say they are seeing this kind of thing in real time. They're seeing it because they live outside of the US. So therefore, in the US, could some of our companies have shrinking revenue margins, ability to pay and grow dividends? Possibly. There's risk. And so I want to hedge against this risk. I want to hedge against it with an international play. And so I bought an international ETF. I will get to it. But again, there's a lot of backstory I want to share first. The background is important because I want to communicate with all of you my thought process. Of course, this is not investment advice. I'm just sharing my journey for fun and entertainment. I have all the disclaimers, disclosures in the description below. Please read those. But I want to share all the background because it builds. This is a story. So I start thinking in game theory. Check it out on the screen. I think in game theory because it's not so simple. It's never so simple. So let's just look at it. My conclusion for a very long time has been, hey, the game is complex, so I'm just going to diversify. I'm going to keep diversifying. Of course, never compromising quality. I have to buy quality dividend growth stocks, and I'm skewing more towards higher yield these days, and I always try to skew towards buying value. But let's keep going down this path. Example. The big, beautiful bill that just went through, there are some concerns about this US foreign taxes. And basically, I haven't really looked into this that much actually until someone over, I think it was on my comments here on YouTube. I appreciate this. Someone commented it on YouTube and they shared this with me. As you can see on the screen, here's just the headline of what we're seeing. But long story short, as part of the sweeping legislation that's happening right now, there may be a scenario where foreign investors outside of the US, they're disincentivized to invest in US stocks, such as the dividend growth stocks that I own. And so that's possible because they're going to be taxed higher. But as you can see on the screen, I want to keep going. So let's go down the game theory. Basically, okay, we disincentivize foreign investment in US companies. All else being equal, this would lower the share prices of the stocks I own, and it would increase starting yields. Meaning US investors, honestly, like myself, I wouldn't mind it, get more value for our dollars invested, get more cash flow immediately, dividends that are being reinvested, reinvest at better yields. Good stuff, right? Not necessarily. There's unintended consequences of everything. It's a chain reaction of dominoes, in my opinion. So it just doesn't stop there. Think about it. If we have these taxes on foreign capital coming into the US, into our US companies, well, foreign countries, they may retaliate in some ways. They may levy countermeasures on US companies, the multinationals that I own, doing business internationally. These businesses could lose revenue and earnings over time. The businesses maybe no longer could increase the dividends at the same rates, may even have to shrink dividends. Basically, valuations, they're not even lower anymore because PEs start going up again because earnings are down, yields go down because the companies can't sustain the dividends as well because the international revenue dries up, fundamentals deteriorate possibly. And so basically, I want pure play international stocks in my portfolio because those are what's going to pick up the slack. If we see this kind of world where countries are focused more inward, there's less global trade over time, I would venture to say that US stock prices for the multinationals could go down and foreign companies that have honestly not really had the bull market that we've had here in the US, they could start surging over time as their earnings and fundamentals grow. But as you can see on the screen in front of you right now, my conclusion is, look, there's so many ways it could play out. This is just one game theory, but I need to diversify more than ever before. And so, of course, because I need to diversify, I started researching on my own, but I know the collective intelligence of this community is huge, especially on PPCE and dividend stock investing for everyone over on X, also on Blossom. I posed a question, and as you can see on the screen, I just asked, what are your favorite ETFs for the pure play international stocks that are dividend growth stocks? I got a lot of great suggestions. I list a lot of them here, not all of them, because some of the suggestions were lower yielding stocks. And I don't want a lower yielding stock. I need, or an ETF for that matter. I need higher yielding ETFs. I need cash flow now. I want dividend income right now. And so these were some of the quote unquote finalists of the list, but there were many other good suggestions. You can see them all on the screen. And so basically what ended up happening is I narrowed it down to two selections, two ETFs, SCHY and IDVO. I want to go over both of those right now. I'm going to break the suspense at this point. You've been waiting long enough. I went ahead and I bought SCHY. My patrons already know this. I'll link to my Patreon in the pinned comment below. As you can see on the screen, let's look at some metrics. And so there are two ETFs that I narrowed it down to. And you guys know I'm huge on SCHD as well. And so I include that on the screen because that's part of this comparison. So SCHD, it's the Schwab US. These are US stocks, US equity ETF. It tracks as best as possible the Dow Jones US 100 Dividend Index. And I've been buying it. You know that is a starting yield around 3.97%. They're growing the distribution on average by 11.44% per year, although that will probably go down over time. So what is SCHY? Well, this is basically the international equivalent of SCHD. It owns stocks that are based outside of the US, and it's the Dow Jones International Dividend 100 Index. It does the best it can to track that index. This is actually what I ended up buying. And right now, the starting yield on SCHY is a solid 3.89%. And I don't really have a dividend growth rate on it at this time because it's newer. They changed really the payout schedule over time. It's hard to get a comp. Time will tell how the dividends grow, but I think it will be a solid dividend growth ETF for pure play exposure outside of the US. Now, what is IDVO? This is the Amplify CWP International Enhanced Dividend Income ETF. This is an actively managed cover call strategy ETF. Many of you remember, probably, I did a video, I'll link to it in the pinned comment below, on DIVO. If I were to invest in a covered call ETF, that's probably the one I'd buy. IDVO is a covered call ETF that's international. That's the best way to look at it. It's kind of the sibling, if you will, of DIVO. Same with SCHD. Its international sibling is SCHY, the ETF that I bought. But as you can see on the screen, let's just look at these side by side. So it's worth noting that SCHD and SCHY both have a similar starting yield. One thing I really want to mention there that helped influence my strategy is that the dividends seem to be qualified, and there seems to be foreign tax credits with SCHY. And I'm sure there's some ordinary income in there as well. Time will tell. But basically, SCHY seemed to be, as far as I could tell, based on what I read on the internet, more tax efficient for a taxable non-retirement account than IDVO. And so IDVO, based on what I read, and put in the comments below if you own it and you've seen something different, but it seems that the distributions are mostly ordinary income based on my online reading. And so I get a 3.89% at a preferential tax status, or 5.64, which is much higher with IDVO because they do the covered calls. Really, to me, that 5.64 isn't meaningfully higher than the 3.89 because of the tax treatment in my tax situation. And so that's one point of comparison where the yield, it's not really higher for me because of the way I'm holding it and the way that I plan to manage the international ETF. Also worth noting, the market cap of SCHY and IDVO are very low, both of them, but SCHY was over $1 billion, where IDVO was only $226 million. For me, I feel more comfortable with a higher market cap or net asset value, assets under management, that kind of thing. Now, of course, I won't really know my tax situation with SCHY until I go through my first tax year with it. Once I have, I'll try to report back here on YouTube. Of course, I never offer any kind of tax advice. I'm just sharing my personal experience for fun and entertainment. But I did a whole matrix, and so I want to share that with you because this is my thought process on why I picked one versus the other. But honestly, I could see myself adding IDVO at some point. I could see myself adding DIVO at some point. But right now, I wanted to start out with SCHY because it complements my SCHD so well. But let's do this. As you can see on the screen in front of you right now, I want to look at my matrix. And so I created this matrix that helped me with my decisioning. And you can see when I narrowed it down to the two, how did I compare them? How did I compare the two? And so what are some of the pros of SCHY? A big pro for me, because I'm buy and hold forever, is passive management. I like the fact that it's algorithmic because it never really relies on a portfolio manager to pick stocks or covered calls. It's just passive. And something passive can be perpetuated for a long amount of time. Even if managers come and go, I don't have to worry about that. I like the fact that the expense ratio is really low. It's a super low expense ratio, and so I don't have to pay too much to Schwab for them to manage this. I like the scale of it being over $1 billion. I like the algorithmic management. I highlight this, and I already spoke on this, but I think it's important to mention this again. Based on my reading online, and literally this is on Reddit and other forums, I'll have to see once I get my first tax statement, but it's possibly more tax efficient for individual accounts based on my reading so far. I'll only know over time. I also felt it's just a good complement to SCHD. It's really the sibling, if you will, of SCHD. It has a great starting yield. I believe there's going to be foreseeable distribution growth. I like the massive instant diversification of 100 positions. The website says 142, but a lot of those are foreign currencies. And it has a extremely low portfolio overlap, only 8% overlap with my portfolio, and I'll get to that in a minute. Something else that I would say is a pro with SCHY, when I was analyzing the positions, and I'll get into this in a minute, it looks like they're purchasing those positions on the international exchanges in the international currencies. I prefer that because it opens up their universe to more stocks, whereas with IDVO, they're buying ADRs, American Depository Receipts, and ADRs have fees that are accompanied with them, by the way, and there's fewer ADRs than international stocks in general. And so I believe SCHY has a bigger universe that the algorithm can pick from. I love that about it. But as you can see on the screen, check it out. And so the cons, what's a con with SCHY? It's selecting some pretty obvious names, more obvious names. Well, it's not actively managed. It has an algorithm. The algorithm is picking the big winner-takes-all type of international companies. It's not picking the up-and-comers as much as IDVO, but that's part of it. It's skewing towards really developed international markets. It may overlook smaller opportunities in emerging markets. I may require, honestly, with SCHY, another ETF to pick up deeper emerging market exposure, and that would be maybe where something else like IDVO or something else comes in the future. But let's keep going. On the right-hand side of the screen, as you can see, I want to go through IDVO. What are the pros with this? Well, you get dividends and covered calls. Here's one of the things I just want to take a step back. I really feel in this market, I put a whole post on this on my Patreon about this. I think of my life and my life as an investor in terms of hedges. I have all these different hedges, hedge against any kind of case that comes my way. And one of the ways I want to hedge against my strategy at some point is with covered calls. Because covered calls don't even rely on a company's earnings to do well. They don't rely on the dividend growth. They don't rely on the fundamentals. It's just market volatility helps generate options premiums. And so I like that about IDVO, because if I do believe we're moving into a time, probably in the US, maybe even internationally, who knows, but if we are moving more into a bear market territory for a while, covered call strategy could help me benefit from the volatility. And I don't have any covered calls at this time. And so I love that about IDVO. It would have given me a hedge that I don't have, but I'm going to have to pick up that hedge some other way in the future. But as you can see on the screen, I want to keep going. That was one of the big pros, is not only dividends, but covered calls. At some point, I really want covered call exposure. I just said that. That's the huge point here. I also think active management is really probably an asset in these emerging international markets. I think active management can probably uncover some real value there in international markets. I like that it can buy lower dividend payers as well. Because it has the covered call income, they don't have to just buy higher yielders. IDVO can pick up some of these lower yielders that are more up-and-comers that might be dividend growers. The high starting yield is great, especially for those in tax-advantaged accounts, not tax advice. But I'm buying this in an individual taxable account, so hence my preference for SCHY. I love that it pays monthly dividends. I'm telling you, as someone that uses dividends right now for semi-fi or for kind of living a hybrid lifestyle right now and enjoying the fruits of my labor, enjoying the fruits of my dividend portfolio, that predictable monthly cash flow is huge. And IDVO produces that. Extremely low existing portfolio overlap, even lower than SCHY. It comes in at 4.6%. What are some of the cons with IDVO? Well, it's really small. 226 million is a small fund. Relies on active management. It's only as good as the management. Doesn't appear to be tax efficient from a taxable account standpoint. Ultimately, for me, I'm not really sure that the yield is any better than SCHY because I'm holding it in a taxable account. Buying ADRs, as I mentioned, instead of buying positions on international exchanges. It limits the universe. Higher expense ratio at 0.66%, although I don't really see it being too bad. And so that was my comparison of the two. I want to go into some of the positions, though, now, just so you can see that there's really no overlap with my portfolio, which is one of the reasons I bought SCHY for that massive portfolio diversification. And I know it's buying quality because I know the criteria the algorithm is going through is very similar to the criteria of SCHD, which I own here in the US. It's my US focused ETF. But as you can see on the screen, let's go through some of the positions really quickly. I'm just sharing them in front of you right there for SCHY. I'll do that one first. And I highlight the ones that overlap. The only two that overlap are British American and Unilever. You can see everything else on there, and you can see on the tickers Some of these are just digits. You can see these are companies from all over the world. These aren't ADRs. This is the real deal from the international markets that honestly gives me great exposure all around the world. And if there is the case that the U.S. kind of turns more inward, other countries turn more inward, again, there may be opportunities here for these companies to pick up some of the slack. There may be opportunities here for them to grow, and I want that hedge in my portfolio. So you can see all the names there. Honestly, I look at this screen. I've heard of a lot of the companies, not all of them. There's a lot of companies on the screen I've not even heard of, which I love. I love that. But I want to keep going. As you can see on the screen in front of you right now, here's IDVO. You can see their portfolio list right there. And the overlap with my portfolio is with Philip Morris International, ticker PM, and with Unilever. And it's even lower overlap than with SCHY. Again, some really solid choices in there. And you can see the choices that they're making are different a bit than SCHY. And I think IDVO is doing a really great job at active management. And so that was ultimately my decision process. It was a long and thorough analysis. I truly appreciate all of my friends on X. I'll link in the pinned comment below to my profile. Blossom, which also I'll link to in the pinned comment below. Some great discussion, great suggestions. I would say going forward, for me, as a Thug Life investor, I want to diversify more than ever before. I'm staying the course. I'm not giving up. It's not game over for me. I'm full steam ahead, but I'm realizing that our world is changing, and so I need to diversify. I need to hedge. I need to be ready for what's to come, and anything could come. We see things changing in the political news, which affects the markets almost daily, and so I want to be prepared for that, and that's what I'm doing. I think going forward for this year, I'm still going to skew heavier to SCHD, but I'll probably start picking up a lot of SCHY as well. I'm looking at them. Who remembers? Put in the comments below. Back in the day, I used to own United Technologies, and then it became Raytheon Technologies, Otis, and Carrier. And I still own them all. They've done great. Some of my best investments I've made. I said way back in the day, when they split, I'm going to treat them as one. Because it's still one. It's the different companies, but it's all part of the same root company. I look at it kind of like that with SCHY and SCHD. They're two different ETFs, but they really belong together. I was so fascinated. I hadn't really heard of SCHY until someone pointed it out for me on Blossom. I think someone pointed out probably on X too. I appreciate all of you. I really do. And I was like, a light bulb went off and it just clicked. I'm like, wait, this is kind of like UTX from back in the day. They probably should have just been the same fund, but they're different to give investors options on how to target. But boy, it's kind of the same thing. And so I feel so good now about just buying them in tandem. And I'll probably do like a 60-40 split going forward. I could see these two positions over the long run comprising a good chunk of my portfolio, maybe even clearly in the top 5, top 10. I think SCHD at some point over the next 2 years will be number 1, and SCHY probably make it up there into the top 10, maybe even top 5. So we'll see. Put in the comments below what you think. I'd love to know what you think. Is your strategy evolving like mine? To not give up or anything, but to realize the world is changing before our eyes. And therefore, strategies in dividend investing, passive income investing must evolve as well. I'd love to know. Please share in the comment below. And have any of you who, like me, started out with individual stocks? And again, the individual stocks, they're always going to comprise the lion's share of my portfolio. I think there'll always be probably at least 60-70% of my portfolio. But have any of you, like me, morphed into more of an ETF investor on a go-forward basis? I'm so excited about ETFs for me, where I'm at with my risk tolerance, the stage of life I'm at, where our world from a geopolitical standpoint is at. I feel good about being an ETF investor here. Share your story in the pinned comment below. And if you enjoyed the video, please don't forget to click the like button. It means the world to me. And I want to close out again, as you can see on the screen. Check it out. This is the most important slide of it all. It's so easy to get scared because there's so much news, but at a meta level, I am staying the course and I am doing what I do with dividend growth investing. Everyone, I appreciate you. If you enjoyed the video, please also don't forget to subscribe and Before I go, in terms of a full disclosure, I own the stocks mentioned today. I am long Raytheon Technology, RTX. I am long Otis, ticker OTIS. I'm long Carrier, ticker CARR. I'm long British American, BTI, Unilever, ticker UL. I'm long Philip Morris, ticker PM. I'm long the ETF SCHD. I'm long the ETF SCHY. Before I go, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. Please consult your licensed investment advisor before making any financial decisions. I'm just sharing my journey for fun and entertainment, and I'll link in the description below, as I always do, to my disclosures and disclaimers. Thank you everyone for watching the video. It means the world to me. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.